I am happy. Matt called and said a few weeks ago, you want to talk to Tom Lee? I said, hell yeah. And I'll tell you why. It's not just because Tom has been directionally correct on the markets, which, by the way, is extraordinarily rare. Most managers, most strategists, most analysts suck at predicting the future. They're terrible at it. Almost everybody is. There's a whole chapter in my book about why nobody can predict the future right, which I recommend to you. Shut Up and Keep Talking, my book. Here's my plug. And Tom has had a remarkably great track record, but that's not why I said yes. There's a couple reasons. Number one, Tom is one of the most decent human beings you will ever meet in your life. And I can tell you that I don't have a lot of people on Wall Street that I think are truly, truly great human beings. Tom Lee is one of them. Number two, there is a certain beauty and clarity to his mind, to the way he speaks and to the way he writes. My mother can understand Tom Lee. And believe me, that is a great art form. The ability to speak, take what you know and translate it into terms that people can understand without sounding like you're selling something or you're obfuscating something or you're outright bullshitting somebody is a real art. In addition, as a journalist, as a guy who writes for a living as well as talking for a living, I can tell you Tom Lee is one of the finest newsletter writers I've ever seen. Now, Tom's not a one-man operation. He doesn't write everything. He has people helping him put it out. But I'm going to tell you that the way he talks is reflected in the way his newsletter is written. I get about 800 emails a day. 80% of it is crap. I mean crap. And I don't mean like, fan letters. I mean people who are professionals saying this is what my desk said today about home building. Most of it's garbage. It's terrible. 10% I glance at to see if there's anything new. 10% I'll look at a little bit more. I read maybe a half a dozen newsletters, maybe 8. Tom Lee is one of them that I will spend 8 to 10 minutes actually looking at on a daily basis. Because when I come away from that, I know exactly what he's thinking. It helps that I generally am aligned with his method of looking at things, of fundamental analysis, but simply looking at the world in the right way. So when Matt called and said, you want to talk to Tom Lee about the markets and where we are, I said yes. And I advise you to listen to what Tom has to say. So with that introduction, I can't do any better than that, right? I mean, Tom and I have been friends for a while. And the important thing is just your ability to express what you're thinking so beautifully. And as a journalist, I want you to know I really do appreciate that. Let's talk about the markets. Where are we right now? The S&P is up, 40, I think, today. We had a day on Friday. There was no tariff news. Market went up. There wasn't any disastrous things that happened on the weekend. The market rose a little bit here today. Just tell us a little bit about where you think we are right now.
Thank you, Bob, for the intro, by the way. Appreciate it.
I meant it.
Yeah. I think the market's trying to catch its breath right now because we had 2 years of 20% gains, so we know a lot of good news was priced in. And now with a new administration and really a bold plan to use tariffs, to sort of fix the economy and this part of a bigger plan to fix taxes and DOGE to cut government spending, there is a natural, markets want to sit on their hands and wait and see what's happening. And so I think that's why we've had the kind of decline we did, but 10% in 20 days, that's a high-speed decline. That's what we would call a waterfall stock market decline, and there's something that you should be mindful of. A waterfall decline can be the start of a crisis, like that happened in 2020, or it could be just the markets panicking. And with a 10% decline pricing and a 40% chance of a recession, I think we're probably more in the category the market panicked because there's a lot of uncertainty right now. But I think we're going to get through this because we know there is a Fed put, and that's, we'll have an Insight Wednesday, but I think it's going to be a very dovish Fed. And as far as Washington goes, I do think we are living in a period of uncertainty for now. Maybe people picked April 2nd as the time that they think something will be clarifying, which is too long for people to wait. But my guess is you're going to have some clarity before then. And then from there, I think investors are going to realize that a lot of great stocks have come in, I mean, hugely. And the S&P's down 10, but a lot of good stocks are down 50%. And I think that's why, there's a very good chance we made our low for the first half already, or maybe for the year.
I want to talk to you about the Fed put, but first I just want to pick up on this waterfall that you were talking about. So we've had a garden variety 10% correction, which is as all of you know, you're market professional. It happens very often. And there was very good reasons for this, it seems to be. We had high valuations. We have the whole Doge concerns and cuts there. But the market seems to be telling us that there's something else going, that tariffs may be the secret sauce that could slip us into a recession. So are those fears well-founded about tariffs?
Yeah, I think it is a valid concern that what has caught everybody off guard, including us, is that the tariff headlines, we understand, okay, Trump wants maximum leverage, so he's going to speak with as much force as possible, and that should rattle markets and leaders and try to force a negotiation. But I think what is surprising is how quickly business confidence has collapsed and consumer sentiment has collapsed, and actually it's actually dragged down economic activity. So I think we are now risking the economy hitting stall speed if we have tough talks. And look, it's pretty evident. This weekend it was a quiet weekend because I think they realized, this message of like, we're okay if the economy rolls, that's a huge tactical mistake because as soon as, do you remember what Fed Chair Powell said in August when he says there's pain ahead? I mean, that triggered a pretty big growth scare.
Yeah. What worried me was Delta. Delta was sort of the first company, this was like a week and a half ago, the CEO came out and said, listen, all this volatility is starting to affect us, and they lowered their earnings estimates. I mean, that's a shot across the bow right there because, strategists like Tom make comments very quickly, but analysts are very slow to move. They basically wait for cues from the CEOs. The CEO of a big company, a big transport company, was just giving them the okay to cut their earnings estimates. And my concern was when I saw that, I've been covering the market since 1997, that's a bad sign. That's a sign that the analysts are going to start moving. So you can have another wave down where you have an initial leg down just on fears, and then people start cutting the estimates at this point. So that's sort of my concern. The market seems to be saying that tariffs are inflationary and are drag on earnings and the economy. And it seems like the market is saying we want tariffs to go away. I mean, the president obviously doesn't agree with that interpretation, but that seems to be what the market is saying. Is that a reasonable interpretation?
Yes, and I mean, first of all, to your point, the pre-announcements are a very bad sign because that didn't happen with other drawdowns, right? Like last August, we had a 10%. It's not like companies were pre-announcing; things got softer. I think tariffs are a financial restructuring of like the U.S. economy. So there's clearly a lot of uncertainty, but also everyone here needs to keep in mind a president can't restructure the economy unless Congress changes the law. So whatever tariffs get announced on August 2nd or April 2nd, those aren't going to last beyond the administration or whatever period set because unless Congress actually passes a law, they're just temporary. So given how much would be involved in actually getting all the congressmen and their constituents to support a change in like tariff laws, I think it's probably easier to just negotiate a deal before April.
Well, so April 2nd is sort of the big date he keeps bringing up for more tariff headlines. And like I said, the market wants this all to go away. So what are the chances some deal will be negotiated away? I mean, basically the market has come to believe that all along, but now they're trying to basically say, no, we're quite serious about this.
Yeah, it's unpredictable because, as you know, nobody in Washington really probably can tell. But I would say the most probable thing is there's a deal before April 2nd. And if you want to see like the biggest proof of it, just look at the stock markets of China, Europe, Canada, Mexico. They've all been outperforming the S&P. There's no way if there were punitive tariffs that were about to be implemented that would cause a recession, guaranteed in Canada and Mexico, that their stock market should outperform. So I think, besides what the S&P's done in falling 10%, I would say that market signal, especially the bond market, tells us it's just.
So what are the outlines of a deal then? That we'll still have tariffs, not as many? I mean, what would a deal look like? We're talking about a lot of countries here. We're talking Europe, Canada, Mexico, and China, essentially, and maybe even more, heaven knows. I mean, 200%, tariff on champagne, that really alarmed me. Let me tell you, I switched to sake. I don't know about what you guys are doing, but what's the outlines of a deal?
Yeah. I mean, first of all, like, tariffs are so complex. Like, Ken went through and tried to calculate tariff rates for U.S. bilaterally with different countries, and you can weight it by trade or you can do equal weight. And by the way, when you do that, none of the numbers match up to what Bank of America's tariff numbers are. Like, nobody actually knows the real tariffs. I mean, it's really hard to calculate, which also means, like, how can you, by April 2nd, negotiate 100,000 line items with, like, bilateral with all these countries? So I think that there has to be concepts that are agreed upon. And, like, for instance, with China, very likely a lot of it has to do with AI and intellectual property, not necessarily steel and aluminum.
Well, let me switch here, or move over to China. You brought it up. Where does China fit in all this? I've been a little surprised that China hasn't been a little more dominant in the conversations. I wonder if the Chinese are wondering that too, because they seem to have been sidelined a little bit, and perhaps because of what's going on in Europe, perhaps because of a certain obsession with Canada and Mexico. But tell me about China and what you think is going on there.
I mean, I'd just be guessing because I don't know. But, it's obvious that if someone said, okay, who should be the bullseye of this tariff war, it really should be China, because we know China subsidizes so many things. And, look at even processing of rare earth minerals, right? China has created a monopoly through their direct subsidies. And yet, in all this public rhetoric, that's like the one country that's hardly named. And it shouldn't be like, oh, it's obvious because Trump knows we all don't. We know you need a new deal. I would probably interpret it to say they must be making progress, so he's decided not to sort of bash them to bring them to the table. And that would probably explain why NVIDIA has been outperforming as well.
Yeah. So more tariffs, less tariffs? I mean, he was talking 10% additional tariffs on China at this point. The NVIDIA thing is an interesting tell. So you think the fact that NVIDIA is certainly outperforming is a tell there for China?
Yeah, I think if there was a global trade war and we risked a recession, NVIDIA would still be derating. The PE should be coming down because all of a sudden everyone wouldn't even know what the E looks like, But so the fact that that's stabilized, I think, is very telling. And, at the end of the day, if you think about the next 10 years, I don't think it's lost on the administration that whatever we're fighting for, like onshoring, it's a very different argument in 10 years, because in 10 years, robots are going to be very capable, and AI is going to make the robots a lot more fire and forget. So if you want to make iPhones in America with like robots that have the dexterity of a worker in China, that's going to actually be economically possible. So maybe they're coming to some agreement on robot technology, because China is way ahead of the U.S. on that. So I'm just guessing. Like I don't know.
Let me turn to the rest of the world. The U.S. has outperformed essentially for the last 15 years. Those of you who believe in diversified portfolios and grew up under the tutelage of Jack Bogle from Vanguard, which I did, and believe me, he was a big believer in that, had a big problem with diversification for the last 15 years. Finally, Europe's outperforming, but partly this is on a reflation story around Ukraine, I think. It seems to be. Where does global diversification fit in your thinking these days?
Well, this is tricky, and if we look at it from the lens of like how the folks here want to diversify, we've actually looked at why regions outperformed over the last 50 years. So like, why did the frontier trade work for a while, and then why did China outperform, and then why did India start working, and maybe now MENA, like Africa? So part one is those regions, okay, starting in the 70s, the region that actually had prime age worker surplus was China, Hong Kong, Taiwan, like the Asia tigers. And then they actually then had a demographic flip. And then in the 2000s, China had the surplus worker, a prime age workforce. Part of it was the rural to urban. But then China flipped. And then, as you know, both regions started to underperform the rest of the world. Then the only two regions that actually have this demographic tailwind outside the US is India, which has been in place since the mid-2010s, and then Africa after that. So why has India been outperforming? I would say it's primarily demographics. But
so does this explain almost all of the recent outperformance outside the United States in the last 50 years? I mean, you're going all the way back to the BRIC countries, for heaven's sake, a long time ago. Is that really a primary factor in explaining outperformance?
Yeah, like if you want to know what Templeton got right when he did the frontier, was he probably just recognized the dynamism of the population. And then that was allowing capital to flow to that region, because if you have cheap labor, then you can build factories, right? That's going to change, right, in the future, because robots can like supplant demographics anyways. But I think the second thing like the audience should be aware of is most other countries are made, the index of Korea is made of like 3 good stocks, and then everything else is bad. And like that's why Samsung's like 30% of the index. So when you're buying outside the US, you're actually making a stock bet. And that's why if you look at the 50 best companies in the world, I bet 47 are in the US. I mean, so I think that's, like, it's not correct to say I want to bet on Europe because it's cheap. You should really be buying Europe because you want to buy, Novo, or you want to buy a German industrial. But, like, you're not going to benefit by saying I want to have exposure to the German economy.
So what's the right advice to give to these people for their clients? Should they overweight outside the United States, underweight? Should it be 10%? I mean, what kind of advice are you giving these people?
Well, if someone's trying to do have exposure through passive, then I would say and you want non-U.S., I would recommend something that tracks the MSCI ACWI. The global index, because that way you're
weighted towards the biggest companies, the Samsungs of the world.
Yeah, it's a cap-weighted index.
Yeah.
But then I wouldn't recommend someone saying, well, the U.S. is done, and so the next 10 years, because it got expensive, I'll just buy Europe. Unless you're really confident Europe has the same number of good companies with the innovation and regulatory freedom.
Oh boy, that's a big lineup.
And a buyback culture, and a CEO obsessed with the stock price, and employees who get a lot of stock so they care about what the stock does, and in a regulatory environment that's getting better, then you should buy that country. But just in the U.S.,
But you're answering your question. You seem to be cynical about whether that's actually available.
I mean, I would make it more of a demographic play. Like, I'd bet on Africa and India because they have got a lot of good things happen when you have surplus workforce.
It is remarkable when you look at Europe, the dearth of tech companies that are there. There's there's ASML and Infosys, and not much else there. And a lot of people don't use demographics. They just say, look, there has been no great European tech companies in the last 15 years at all. And I can't help but think, given the emphasis on growth in the last 15 years in the United States, certainly growth over value, that's got to be a factor as well. And that goes back to what you were saying before. Your little list there is like basically you're saying there's a lack of innovation.
Yes, correct. And I'm not trying to be snarky here, but when you're buying Europe, you're just buying government spending. That's the largest driver of the European economy is the government. I mean, there's dynastic wealth held by high net worth people in Europe, but they're not transforming capital flow. I mean, like the Middle East is probably more likely to be where there's innovation of capital because of capital surplus.
I want to go back to the United States here and talk about the put you were talking about before, all these puts that are supposed to be under the market. So is the Fed put coming back? And I want to talk about the Trump put. Does it even exist at all? So let's talk about the Fed put. How evident would this be this Wednesday when Jerome Powell speaks?
Yeah, there's a couple things to keep in mind. The Fed put has always existed because, with the exception of Volcker, but Powell's talked about this, there's a recognition that the stock market is the sentiment indicator of the economy. Like, if you tank the stock market, there's no GDP expansion. Consumer confidence doesn't go up if the stock market crashes. But that message got muddled the last couple of years because inflation made it hard for the Fed to actually try to support the stock market. And I'm not trying to rile the waters, but I think there is a political dimension because the White House is very divisive. Half the country didn't vote for the current president, and I think the Federal Reserve, even though they're independent, many of the people that work at the Fed, I think it's 94% of donations were to Biden's reelection. So it's clearly an institution that favored the party that lost. And I think that's why it's been hard for Powell to be like, I can ignore tariff headlines. I think because, he's got an entire organization that doesn't agree with him. But I think the put exists because 2 weeks ago, Fed Chair Powell was speaking, and he talked about in 2019, tariffs were inflationary, but he still cut rates 3 times.
So what's Powell going to do on Wednesday? How's he going to present this? I mean, obviously, I don't think people are expecting rate cuts on Wednesday, but there is a slowing in the economy that we've seen. How does he balance that against the inflation concerns?
Well, I think he's going to be very sober, and he's going to point out that whatever economic data you've seen as official numbers, like the February CPI that just came out, that's like stale because we're already like into 1 month later. And he already knows from all the Beige Book and the regional surveys that like the underlying economy is slowing much worse. So I think he's going to say he expects conditions to be a lot softer on labor and inflation. And I think that's when he'll be prepared, or at least the balance of risks have changed. And I think markets are going to price in a May cut. And that should be pretty positive for stocks.
So the odds of a May cut will go up after Wednesday. You think he'll be? Yeah, that makes a lot of sense to me. How about the Trump put? Is it real? Does it exist? See, they seem to want to poo-poo that and make it go away. What about that?
Imagine like the CEO of the largest stock in the world, okay? Like NVIDIA. And like every employee of NVIDIA like has made their money on the stock of NVIDIA. And then Jensen Huang's like, I don't really care what the stock does. It could go down 20%, not going to change what we do. Like, there's no way he would ever say that. Or if he says that, there would be a revolt. I think the White House, of course, wants not to be constrained by what the stock market's doing, but it is literally the barometer of the economy. And voter, he can't, if the stock market falls 20%, I would say that you're going to have to start to say there's a 90% chance of a recession. And things are going to break because people can't get refinanced. And there's going to be public company failures. So there is a put. And it's inconvenient at the moment because the Trump put on the stock market undermines his efforts to negotiate a good tariff deal. So I understand why they want people to try to ignore it, but I think there is a put. It's almost, Professor Jeremy Siegel said, of course there's a put, and I agree. It's just inconvenient to say there's a put right now.
It is rather remarkable that the president made it clear in his first administration he cared very much about the stock market, and now he seems to want to poo-poo that. It's kind of remarkable when asked about the recent selling, he called the people selling globalists. That's kind of a remarkable change of attitude. But everything you're saying makes sense. How could he not care? It'd be crazy that he doesn't care at this point. Let me ask you about sort of the whole meme stock thing in general. You used an interesting term in your newsletter. He comes up with an interesting word, rage selling, a couple of weeks ago. And I look at Tesla, and the question is, look what happened there. I mean, was it worth double its value from November to December? Tesla doubled, essentially, in that period. Did suddenly the fundamentals completely change? And then all of a sudden it was worth 15% one day last Monday. It's kind of like remarkable. I know it might seem weird to call Tesla a meme stock, but I mean, that is a little odd. That's more than odd. It's bizarre about that. How do you address that in the modern world for those of us who still give a damn about fundamentals?
Well, there is something. I've been doing research since 1993, so 33 years. And 33 years ago, like the institutional investor said long-term meant 12 months. And so they didn't care about anything that you had to say unless it was going to change the 12-month outlook. And then probably in the 2010s, that changed to 1 quarter. Okay, so that was 15 years ago. And now in the institutional world, because of all these ways people measure factor and your risk and your value at risk, it's like 30 days. So people don't care if something's 31 days from now. If the stock's going down next 29 days, they're gonna sell. And people have instant liquidity. So it's not just like someone in Robinhood that can go to zero. Any major hedge fund can essentially turn their beta to zero. They can literally go to flat on the market with a push of a button. So I think the stock market does face rage selling now. And MIT had a very big headline study that came out in 2020 that said something like 57% of adult males rage sell. Meaning like, it's actually, so if you look at the stock market.
By rage selling, you mean they just irrationally come in and decide to sell on a hunch, like
yeah,
they're done, or is there rage buying?
Yeah, so they're literally like, imagine like a race car that's going 100 and 0, like there's no speed in the middle, whereas a female don't rage sell. So it's actually a gender thing, rage selling.
So would you agree, though, despite the existence of rage selling, as you call it, that in the long term the fundamentals do matter? That in the long term, Tesla is valued by some metric that's fair. I mean, maybe there are exceptions. Maybe GameStop, for example, doesn't necessarily value on a fundamental basis. But in 1602, was it when the Dutch East India Company was founded? The prospectus, which you should read, it's very interesting, lays out the whole case for why you own a stock. They said, when you buy our stock, you are participating in a stream of profits from the spice trade. The Dutch East India Company was originally spice traders. They expanded out, but they went into Asia, into the Moluccas, bought all the spices, brought it back, sold it, and then distributed the profits. And that's what they said. When you buy the stock, you are participating in a future stream of earnings. And ever since then, that's sort of what the fundamental argument has been about the stock market. You are participating in a future stream of earnings. Now, those laws have not been repealed that I am aware of, despite people individually moving on a day-to-day basis.
Yeah.
I'm asking a question here, but I'm trying to state a case here. The fundamentals still do matter.
They do matter, but I will say one thing about Tesla. If in my 33 years, what I find people always or have a high chance of underestimating is the network value or the stickiness of a product, okay? So in other words, like in 2007, when the iPhone came out, okay, my first, because I was a wireless analyst, I actually was like, oh, I mean, everyone uses Nokia and BlackBerry, like who cares about Apple? But within the first 12 months, Apple completely disrupted the industry. I mean, it's not even close. Like since 2007, Apple has taken 99% of all the profits of the wireless industry and like all of the market cap. Tesla, the attachment rate to their product and loyalty is insane. And then look at the loyalty of his employee base. He just pulls a couple of guys and throws it into government, and like they're doing the work of like 100,000 people. So the reason Tesla, I think, is getting hammered is that it's got the My Pillow problem right now. Like, I don't know if you guys remember, like suddenly like I'm not going to buy this pillow because the guy's like saying their election's rigged. And I think people are trying to cancel Tesla. And it could happen, okay, but I'm going to just say that is the single thing you have to bet. If you think Tesla, the attachment rate's going to change, then Tesla's a sell. But if you think there's no change in the pace that they innovate and lead, then stock's going to recover easily.
We got to let you go, but there's a lot of RIAs here, and they're interested. They're going to go back and tell their clients they went to this conference. Maybe they saw you here. What advice would you give RIAs who have to talk to their clients about the market, and what percentage of the market should they be owning long term? Do you have any sage advice for these people here?
Well, yeah, I would say it's been no fun the last 2 months. Really since December, and the level of bearishness that's developed and the de-risking is actually what you expect in a recession. Okay, so I think the markets have overshot, and I wouldn't turn bearish on U.S. structurally because we still have a huge demographic tailwind. It's something that we talk to our clients regularly about, but there is a surplus of prime age workers in the U.S. that's going to last through 2035, and since 1871, no stock market peak has occurred until you've depleted that surplus. So I think we're still in a strong bull market.
Wouldn't a longer-term strategy be to just simply have a plan and stay long, stick with it? If you're 60% equities or 70% equities, this is not the time to be trying to trade your way out of the stock market.
That's right. Yeah. First of all, yeah, you want to be buying dips, but you know, you guys all know that famous stat from Fidelity. Their best performing brokerage accounts are from customers who died.
From customers who died.
Yeah, so
okay, so there's your advice for your clients at home, folks. Best thing you could do is die.
No, I mean, you just don't want to trade.
Oh, did I misunderstand that? I'm sorry. Oh, look, the time is over. I'm dead. Look, we're dead. Hey, folks, always a pleasure to see you. Come up and say hello to Tom when we're done. Thank you, everybody.
Thanks.